let's put in perspective. You mentioned 60%, which is absolutely right. We have been in a terrible bear market for innovation. Hard to understand, but terrible bear market for innovation. However, if you look from the bottom of the coronavirus to that peak in February of 21, we were up 358%. Why? Because innovation solves problems, right? Now we're down 60%, and we have a whole new set of problems, certainly coming out of Russia and Ukraine. If you look at our strategy over a 5-year period, look at the last 5 years, I'm not quite sure what the numbers are, but they are well above our minimum hurdle rate of return, which is 15% at a compound annual rate. And I think over 3 years, we're closer to 25%. So that helps put our performance into perspective. This is a period, if you believe in innovation, and that innovation does solve problems. We had a preview of that after the COVID crisis, when our strategies in the span of a month, many of the stocks were taken down 75% because either they were burning cash or they had low cash cushions. But guess what? Those were the genomics companies that were going to get us out of the coronavirus. And today, what do we have? We have all kinds of problems, the latest of which is Russia, Ukraine, and all of the commodities coming out of that area, especially hitting Europe. I think we're going to be looking at a lot of demand destruction and substitution into innovation. Electric vehicles as opposed to gas-powered vehicles would be the biggest one. We also have labor shortages all over the place. Again, automation. This is innovation at its best, and it's being turbocharged by this environment as the market is really hitting our stocks. So I think if you were to look at the next 5 years, and if you were to give us that 5-year investment time horizon, we are the closest you'll find to a venture capital fund in the public equity markets. If you were to give us that 5 years, given our expectations for growth in these new technologies, I think we're going to see some spectacular returns. It's very hard to say if we've seen peak market impact. I know the markets are getting hit today. Typically, the way we see the peak is through the VIX, the volatility index, and it has moved up. It's in the mid-30s. I'm not sure what this morning is. And the shock in 2018 and the one before that got us into the low 40s. Of course, the coronavirus got us to 80, but we're getting close to those cathartic moments in the past. I would be surprised if we do go to the coronavirus levels, because remember, people were expecting a depression. The whole world shut down. This is not that. This is going to cause a lot of problems from a purchasing power point of view. I think the risk of recession has gone up dramatically as purchasing power is dropping dramatically. In the U.S., the consumer saving rate already is down to levels we have not seen since 2013. So that buffer that the stimulus payments created during the crisis, that's gone. And so consumers are probably going to pull back. Sentiment suggests they will.